Hi, it's Helen Tarrant. Welcome to another episode of Commercial Property Roadshow. You're here with Helen Tarrant, and today I'm actually on holidays in this lovely Nelson Bay in New South Wales, north coast, in near 2 hours or so near Sydney. Now, one of the questions that people ask me often is actually about leases. Leases can be very, very confusing. Now, there's lots of sayings that gets thrown around in the industry: your double nets, your triple nets, your gross leases, your normal net leases. What are all of them? So I'm here to explain to you a little bit about leases and what they are and what are the distinguishing features. So as most leases are, it's an agreement between the landlord and the tenant, or a landlord with a prospective tenant. So normally a lease is drawn up and the lease has criteria and areas you fill in a lease, like how much rent they're paying, how much rental incentives are they getting. And if you're looking for more information about rental incentives, check out my other videos. But rental incentives, and that can be rent free, or they can be to help them with fit out, and or giving them sort of exemptions from outgoings. And also there's areas about how much the rent is it inclusive or plus GST, and also what your tenants are allowed to do in the premise and what they're not allowed to do in the premise. So depending on the type of tenant you are going to get, you might want to prohibit some use, and there's also hours where they're able to access the premise as well. So there's all sorts of things that the leases include. One of the big items in any lease that you construct or put together, or you review any leases when you're looking at buying a property, is that you're looking at how much does the tenant pay in terms of outgoings. So does the tenant pay the standard outgoings, which is what we call a net lease, which means that the tenant is paying your basic outgoings, such as the rates, the insurance or the body corporate, and you have some outgoings like their own usage and water, and also insurance as well. So that's your normal lease, the normal outgoings that your tenant pay for. So that's what we call a normal net lease, where the tenant pays their rent, which let's say maybe $30,000 a year, plus on top of that they pay GST on the rent, and then on top of that it will be they pay the outgoings, which may be proportioned every month, or maybe they may pay it as it comes, which means that they pay for the rates, they pay for insurance, they pay for the strata, and that could be admin and sinking fund, or just admin fund, depending on how the strata or body corporate fees are broken up, as well as their own usage, utilities, and some water rates as well. So that's the basic net lease. Going on from there, we've got what most people will call a double net lease. Now, the double net lease would include adding on top of those I've just mentioned, paying for management fees and possibly land tax as well. So management fees and land tax. So there are two other additional fees which normally traditionally may come out of the landlord or the vendor's pocket, but because your tenant is paying what they call a double net lease, they are paying that additional on top of what they're paying as their normal outgoings. So then it becomes truly set and forget for you, and that kind of properties usually would attract a much sharper yield. So the yield is going to be tighter, the return's going to be a little bit less, but of course less out of pocket for you. So ultimately still means more money in your pocket in the long term as well. So that's your second tier of leases. Then your top tier of leases is what they call a triple net lease. Now, a triple net lease is when your tenant pays for absolutely everything, including structural issues and maintenance of the property. So let's say that you have a childcare center. This is very typical of childcare, medical, large national tenants often do this. So because they occupy such a large space. So they may be logistic companies, there may be a company that is in freight or cold storage, or there may be a company that does that has a particular type of manufacturing that they need to have a particular type of specialist equipment into your property, or they have really heavy trucks or machinery that needs to be freighted across your concrete or driveways, and in that case they're actually paying for the structure or the structural integrity of the property. So a triple net lease essentially is basically having a tenant that pays for all of your outgoings, so your standard outgoings such as your rates, your insurance, if there was body corporate or strata fees, plus all of your rates and utilities. On top of that, they pay for your management fees, your land tax, as well as structural and maintenance. So what does that mean is that it literally means there's no due diligence for you to be done on that property, because they pay for the structural damage. So if, say, there was a roof issue, so there was a leak in the roof and the roof had to be replaced, or certain parts of the roof had to be replaced, the gutters have to be cleaned, the lawns have to be mowed, or that the pillars, say, underpinning the property is damaged for whatever reason, they are responsible to repair it. And so you as the landlord need to just be notified or find out that, do a report, or once a year go through it and find out if there's any issues and give it to the tenant, and the tenant has to fix it as if it's their own property. So that's what we call a triple net lease, which is the toppest tier of leases you can get, which is a total set and forget type of lease that you could buy. And obviously that kind of trades in the market around that 4 to 5%, because you're dealing with brand name tenants, and you usually are, and those type of tenants are usually paying hundreds of $1,000s a year in rent. So your purchase price of that property is going to be somewhere in the multiples of millions. In a smaller sense, you could also get that in smaller medical centers as well. But of course, again, the yield will still trade between that, anywhere from 4 to 5%, and a maximum we might see it getting close to that 6%. But a triple net lease, when they talk about in the industries where everything is absolutely covered, most of the time when you are buying your first commercial property and you're looking at buying a smaller property that's sub 1 mil, most of the time it's just going to be your normal net leases, which means that your tenant pays for all of the standard outgoings, such as insurance, rates, water, and their own usage, and then possibly management fees on top of that, but no land tax. But of course, because you're buying in different states and different entities, that is very personal to you, and you could avoid paying land tax depending on the entity you put into. So that's something, a discussion you need to have with your accountant. So if you're looking at a property and you're not sure how to get started, and you're looking for some guidance, and you're looking at a lease that has tenants paying for some of the outgoings but not all of the outgoings, and you're wondering whether that's a triple net or double net lease or just a standard net lease, reach out to me at helentarrant.com, so helentarrant.com, or email me at helen@commercialpropertycashflow.com.au, because I specialize in helping people buy their first commercial property as a buyer's agent and as an educator. So I'll mentor you through that process as well, so that you know that when you come out at the other end, you are actually a professional investor in the commercial property space. So until next time, in the next episode, don't forget to hit the bell and subscribe, and I'll see you soon. Bye for now.